Good evening, dear members. So, after a hectic July 31st, we are and then almost 20 days break of this CP programs. Now we are all gathered here. I must tell that the due date was not extended by the central government, and there was a hue and clamor that it will be extended, but definitely, as I understand that almost all had planned that there will be no extensions, and we had met the same. And especially the institute has come up with the direction that we should not give representations to the central government that due date should be extended. So, taking from the same, we need to prepare ourselves for this September 30th and October 31st deadlines, and it's all planning and execution. So we all need to plan for the tax audit season. So tax audit season, and of course for the corporate companies also. So to aid the plan, now we have this financial reporting on non-corporate entities. We had this non-corporate entities as a thrust area during this year, and almost 2 to 3 CP seminars were purely concentrating on the same. In fact, we had one dealing with accounting standards on MSMEs. Now, this technical guideline that the institute has come up with on June 22 does deal with this financial reporting on corporate entities, and it's right now non-mandatory. But I happened to have a chat with the faculty sometime before, and it was telling that slowly it will be merged, and what will happen is the non-corporate entities need to have more transparency, like what happens in these corporate entities. And as most of the cases that we do as in Thrissur itself, we do cases is small and medium entities itself, and most of these are non-corporate entities. So in order to get in a bank loan, easy loans and things like that, the financial reporting is should be quite accurate, and it should give it more disclosures. So it will do aid and bring in more transparency, and will do aid for getting more benefits from the government also. So today's subject is going to be handled by CAG Rengarajan, a very efficient faculty, and he does a knowledge powerhouse, and he happens to handle the All Kerala audit. All Kerala, he happens to be the senior partner of Surya and Company, and on behalf of Thrissur branch, I do welcome sir to this seminar. So before the same, I would like to request C.A. Paulson to introduce the faculty.
Respected dignitaries on the dais and very dear members of this elegant profession of chartered accountancy, gracefully sitting in this audience, and who are also glued in the hybrid system of this seminar, who is glued in the Zoom. Wish you all a wonderful evening. Today we have an amazing personality as our speaker of the day, who is going to enrich us this evening. He is a senior partner of one of the leading firm, Surya and Company, and he is presently located in Kochi, the Queen of Arabian Sea and the commercial capital of Kerala. He originally hails from Chennai, and now he is in public practice for so many years in Kochi. He has covered almost all areas of a practicing chartered accountant, covering a wide range of industries, and also some of the large corporates in the region. He carries with him, he's a fellow member of ICA, and he carries with him 15 years of professional practice. Standing here on the stage, I feel privileged, I feel happy, and I am proud to introduce the speaker of the day, Chartered Accountant G. Rengarajan. Thank you.
Respected Chairman, Secretary of Thrissur branch of ICAI, senior members present here in the chapter as well as attending the event or the CP program from Zoom meeting. I thank the chapter for giving me an opportunity. I thank Satishan sir who gave a call to me, asked me whether I would be able to take this session here. So it's a privilege to share knowledge to any in any chapter of ICAI for me. So in that way, I'm very glad that I've made back to Thrissur branch. It's been quite some time. Before COVID, I had a few sessions here, and for the last 2 years, because of COVID, I couldn't take a session here. It's a privilege to come back to the chapter. Today, I'm here to discuss on a particular guidance note which came in June 2022. It's a very new guidance note, and this is going to be the change, or this is going to be the event which is going to change the future of how the profession looks into. Similarly, how the growth of the small and medium-sized enterprise happens in India. I'm talking about this particular guidance note. This is the guidance note which was issued by ICAI in June 2022. So when this guidance note came in, I was taken aback finding out why do we need such a guidance note at this point of time. India has been having big manufacturing sectors, big service industries at one end, and there has been recipients of all this or consumers of all these manufactured goods or services at the other end. And this has always been bridged by a lot of non-corporate entities, and it's been running successfully so far without much of a hindrance in the last 70-75 years in India. So why all of a sudden one particular guidance note? Companies Act 1956 was in picture for such a long time. Income Tax Act 1962 has been in practice for so many years. So what made the institute think that there is a requirement of a guidance note now, which they didn't feel as a requirement in the past? So that's how, or that's what caught my eye when this guidance note came in. And I was really surprised to see how much the institute has spent time thinking on what is the need of the hour and how we have to bridge it. That is the core essence of this particular guidance note. For all of us who have seen corporate audits for quite some time now, from 1956 Act to the 2013 Act, from Schedule 6 to Schedule 3, the format of balance sheet P&L is not something new. We have always been looking at some standard presentation of balance sheet, P&L, its disclosures, accounting standards and compliances. All these are something which is common, and we have been doing it. For a non-corporate entity, when it comes to an audit requirement, we were looking at audits under 44 AB of Income Tax Act, the tax audit requirements. Till a year back, we were looking at GST audit as a compliance part, 9C filing, and financial statements which gets attached to 9C as an requirement. Or there could be some other requirement, say a bank loan approval wants a particular format to be given, or a balance sheet to be prepared and audited, or an authorized by a chartered accountant to be submitted. These things are something which we have seen over the years. Now the institute has come up with a particular guidance note trying to say that there is a bridge which has been constructed by a strong base of non-corporate entities over the years. Even though the manufacturing and the servicing are happening across through bigger corporate entities, the actual delivery or the business is actually run by lot of family-owned businesses which is very prominent in terms of trading or in terms of small time services across the nation. And these have to be strengthened because there is a huge mad rush of how India is developing in a very fast pace. And these bigger corporates are gearing up to the requirement and are progressing in that particular fashion. To that extent is the bridge which is linking the corporates to the consumers. Are they having a very strong base? Are they able to make the utilization, or are they able to utilize themselves in a proper manner to ensure that they are also growing in the same manner? So that is where Institute came up with this particular guidance note to introduce a format of balance sheet and P&L for non-corporate entities. So from March 22 financial statements, there will be a particular format for balance sheet P&L for non-corporate entities also. Okay, so that is where we have to face. This is the reality that we have to face right now, saying that for all non-corporate entities, it could be a partnership firm, it could be a sole proprietorship, it could be an say cooperative society which is not linked to any statutory affiliated or a law affiliated cooperative society. These people are required to form or follow a particular format of balance sheet and P&L. And that is what this guidance note is all about. So for the next 2 hours, we are going to discuss on this particular guidance note on the do's and don'ts of what has happened. So why all this? The guidance note starts with the term saying that the financial statements of these non-corporate entities who form almost 60% of the business world of India are actually presenting financials in what is comfortable or what they feel is required by a particular statute or by a bank requirement. Whatever is the requirement, they are trying to comply with that alone. There is no standard format by which there is a comparability of statements. For example, I'm sure wherever there is a trading of goods, inventory is always valued at lower of cost or net realizable value. We as chartered accountants, when we file our form 3CB, 3CD, emphasize that the management or the non-corporate entity is complying with the accounting standard. There is a separate question in clause 3CD asking whether the stock is valued at lower of cost or net realizable value. We always say yes. So we are ensuring there is a compliance of it. But the accounting standards want us to make it as a disclosure in the financial statements. How many of us are mentioning an accounting policy for the valuation of inventory, whether FIFO method was followed, whether weighted average method was followed for the basis of valuation, whether it is lower of cost or net realizable value? How many of us have presented it or have approved of financial statements which mentions these as the core principles? Answer is a bit lesser. Not all of them make that disclosure. So that is where the comparability and the transparency is taking a hit. And this guidance note is prepared or has been made with the intention to show that we will make or we will authenticate financial statements which is going to make things comparable, transparent, complete, and also unbiased. These 4 words, if you will find across the guidance note. Every other area, you will either find one of these words, and the stress has been given to these 4 fundamental words in the guidance note. So again, when we talk about these non-corporate non-corporate entities, not that it is not complied with any standards. It has been following accounting standards right from the day one. Once ICDS came in, additional disclosures from chartered accountants started coming in form 3CD, in I think clause 13E, 13F and all. We had to make presentations whether ICDS had any change because of compliance of ICDS. whether any change in the financial statements. So, and the disclosures of the ICDS is also made mandatory through that. So a compliance part was forced on to us through the Income Tax Act in ICDS, whereas a proper disclosure of all the accounting standards were not being made in the financial statements. And what do we mean by accounting standards for this particular non-corporate entities? We are, again, we'll go back to our corporate world where we are following accounting standard rules for these small and medium-sized companies. For bigger entities, it's Ind AS these days. So there are different standards which are already being in place, and we are following those accounting standards. But the mother standard for all this is the accounting standards issued by ICAI. So initially, when I started my CA profession, that point of time, the only standard which we used to study was the accounting standard issued by ICAI. That was the basic fundamental standards. From there on, we have the offshoots called as accounting standard rules, which the 1956 Act took in, and which was absorbed by the 2013 Act of Companies Act. And from there on, IFRS becoming a bigger picture, India moved on to Indian accounting standards, which is almost in line with the global standards. So now we have various standards to follow. The accounting standards issued by ICAI, we have the accounting standards issued by Companies Act, then we have the Indian accounting standards, we have the IFRS, and we also have the ICDS requirement when it comes to the income tax requirements. So many standards which have to comply with. But for all this, there is only one mother standard, which is the accounting standards issued by ICAI. Here in this guidance note, the person who has worded the each and every paragraph of guidance note has made it very clear that there is a mother standard, and it is our own standard, the standard issued by ICAI, and we have to start looking at compliance of those standards. And that's where that's where the institute has made a focus in this particular guidance note. This guidance note exclusively talks on a lot of disclosure requirements from the accounting standards portfolio. So what do we mean by non-corporate entities? Any entity which is not covered by Companies Act or LLP Act is a non-corporate entity. That's how the definition comes in. So for all other entities who are not corporatized, it is a non-corporate entity, and for them, this guidance note is of significance. That's where we have to understand. So, like the chairman was saying, this guidance note is only recommendatory in nature. It is not made mandatory, and it cannot be made mandatory because it is issued by ICAI. For a particular format to be followed, it has to be that statute which recommends the particular format of balance sheet and P&L. If it's the RBI Act, the RBI suggests it. If it's a Banking Regulation Act, it suggests the particular format. The Insurance Regulation Act suggests a particular format. Companies Act, there's a Schedule 3, which is a format is prescribed. So a statute always prescribes a format of balance sheet P&L, which is made compulsory for those entities to follow. Being non-corporate in nature, there is no particular statute which is binding all of them together. We can say Income Tax Act for tax audit cases is binding them for the purpose of computation of tax, and a chartered accountant authenticating that the business procedures followed or the allowances and disallowances followed is right or wrong. So ultimately, it is only to determine the taxability of that particular entity and not about the financial statements as such. So there is no particular statute which can make mandatory a particular format for here. So that is why the institute has mentioned that this is only going to be a recommendatory in nature. There's no mandatory requirement to comply with this particular guidance note, but it also emphasizes that it is us, the chartered accountants, who have to make sure that we make it mandatory. at some point of time, everyone should be in the same line of presenting the financial statements so that it becomes very easy to access the information. Who are going to access the information? That's the next question. Now, the stakeholders for these financial statements would be the departments. It could be a GST department, it could be your income tax department. Primarily, it could be the banks who are funding these non-corporate entities. So for them, these financial statements, if it's presented in this particular format, it gives a lot of comfort because there are a lot of additional disclosures which has come in, which will make it very clear that the presentation is in line and it is comparable. Okay, when there are two traded entities and both financial statements are presented to the bank for approval of loan, the way the P&L is drafted will be completely different. In many a times, we will have, say, probably say the sales, cost of goods sold being adjusted, gross profit being identified. From there on, the other expenses being deducted from that, depreciation being deducted, net profit arrived, and we may have a net profit and it's the appropriation in one format. In some people may just have the income, expenditure, net profit. So there is no comparability in the way the presentation happens. Some people may have other income grouped in total income. Some people may have sales, services, other income, total income. So there is no comparability which can be established. Whereas once we start following these guidance notes, then it will become very clear that there is a particular format and all of us will be presenting in a particular way. That's what is this particular requirement. And here we will be giving a lot of notes and disclosure. These are minimal disclosures. Once we start following these particular guidance note, then what happens is the presentation mentioned in the guidance note is the minimal requirement, and any additional requirement from there on can be made, is what this guidance note says. Very, very similar language used in Schedule 3, wherein it says that Schedule 3 is the minimum disclosure. If there's any additional disclosure needed as per a statute or as per an accounting standard, we have to make that additional disclosure. This is only the minimum requirement, is what it emphasizes. So what we are going to see is the format of balance sheet, P&L, and cash flow statements. I think that is something that will come as a surprise to all of us. Cash flow statement and notes and other statements attached. Okay, so I'm sure, 100% sure, we are giving the balance sheet, P&L for all the non-corporate entities. Following a cash flow statement may not have happened so far, unless and otherwise there is an insistence from the bank's point of view on the projections of the cash flow and how they are going to repay the loans and all those stuffs. We may not be thinking of cash flow as a requirement. And the last thing is we will be giving some additional supporting notes, but these notes may not have been cross-referenced so far. For example, we will have in the face of the balance sheet, we will have the partner's capital account, but we may not mention that the details of the partner's capital account is mentioned in note number 2. It will be available, it will be attached to the financial statements, but we don't cross-reference the data on the face of the balance sheet, P&L, to the notes to accounts. Now it is being made mandatory that we cross-reference these kind of activities. So once I say cash flow statements, is cash flow statements applicable to everyone? So should we start presenting a cash flow statement for all these non-corporate entities? Answer is no. Let's be very clear. Answer is no, unless and otherwise your auditee falls under the level 1 category of company or of the entity for whom the standards are applicable. Cash flow statements is not mandatory. Again, accounting standards of ICAI has split it into 4 parts: large, medium, small, and micro. That is how the classification happens for entities under accounting standards issued by ICAI. If you fall under the micro or small category, which is level 3 and level 4, 75 to 80% of the standards and its disclosures are not applicable. Very clearly are not applicable therein. But we don't make a disclosure in our financial statement saying that this is a level 3 entity and that is why these disclosures are not made. We don't make it as a statement in the notes to accounts. If that is available, then to that extent it becomes more compliant to the accounting standards. Since those kind of wordings are not available, it is very difficult for the stakeholders to understand whether a particular accounting standard is missed to disclose or whether it is not applicable to that particular entity. So these are the small differences which we have to look into to see that there is a proper disclosure and a transparency in the way the disclosure happens. The financial statements defined under this particular guidance note also insist that there should be an accounting policy as per the IC accounting standards and the ICDS wherever needed, and that must be presented. In fact, if you see the balance sheet format, they start with own equity and capital, owners funds, and owners funds note number is given as note number 3. They don't even start with note number 1 or note number 2. They start with note number 3. Okay, and towards the end of the balance sheet, you will find significant accounting policies as note number 2. Okay, so now what is note number 1? The background of the entity forms the note number 1. If you see any listed entity these days for the financial statement presentation, there is always a background of that entity. It forms part of the first note. It tells what is the company, where all they have business, what's the primary business, from when all they are complying, if it's a listed company, where all they are listed, and what is the primary business and how the nature of businesses, who is handling it. All these are explained as the background of that entity or the fundamentals of the entity. The second note is the significant accounting policy. Third note becomes a share capital. Here also they have followed the same methodology. So if we are following Schedule 3 format for corporate entities, we will not find this particular format new to us. There's nothing new that this will throw out to us, only a small change here and there. Other than that, nothing new that this guidance note has thrown open to us. If we are complied with Schedule 3, this is very, very simple and similar to follow. Okay, so that's where the insistence comes in. As I told, these formats are only recommendatory in nature. These are not mandatory because of the compliance part that I explained. The disclosure requirements are recommending that the format are additional. If there's anything that is additionally to be given, that has to be given here. And if there's any other statute that you are complying with, that requires you to make additional disclosures. Those disclosures also has to be made. And it also emphasizes that there should be a lot of cross-referencing between the balance sheet P&L and the notes to accounts. All these are some of the key highlights that I have pulled up. Now, the next thing that which may come as a surprise to us is rounding off. I'm sure all of you are aware that the Schedule 3 has undergone a change last year. March 22 accounts, you will not be able to give it in full numbers. Rupees in full will never be accepted as a presentation format for Schedule 3 for March 22 accounts. The words were changed from shall to may and all, may to shall and all those stuffs. So to that extent, every corporate entity has to round it off at least to the nearest hundreds and present the financial statements. You cannot give it in full numbers for March 22. Whereas here it still says you may present it in full format or you may round it off to the nearest hundreds or thousands or lakhs. It is left open to the entity to choose whether they want to round it off or not. Preferably, larger entities can look at rounding off of the financial statements for their presentation. Okay, that again comes into picture. Again, how do you round it off? If the total turnover of the entity is less than 100 crores, then we can round it off to hundreds, thousands, lakhs, or crores, millions, or decimals thereon. If it is more than 100 crores, then we can round it off to lakhs, millions, and crores. That's how they have told. And they have also mentioned that if it is, and one additional factor which has been mentioned is the comparative figure of the previous year. Okay, so far, many a times we may be giving only the current year numbers for the financial statements, because that is what is anyway needed for tax audit purpose. Also, current year profits makes a lot of sense. But for the 3CD purpose, there is a comparable statement for gross profit, net profit, the ratios thereon and stuff. So 90% of us have been giving a comparative statements to be on the safer side, but many of them may not have been giving also. Here, there is a mandatory requirement that we give the previous year number also. And if it's the first year of business, we will not be giving the previous year number, but we must mention that this is the first year of business. These kind of notes have been added wherever needed. So what are these, why these particular format of balance sheet and P&L? These balance sheet and P&L are 100% ITR compliant. What do we mean by ITR compliant? When we see the ITR requirements, we can see that the P&L is broken into a particular format. It starts with the trading activity, the manufacturing activity, then it goes into the sales, then it captures the gross profit. From there, it addresses all the other expenses. From there, it addresses the net profit. From there, it goes into the allowances and disallowances in the schedule BP part. The link, if you can see, for in the ITR, it goes from the net profit. We don't key in the net profit in BP schedule. It is auto-populated. It takes from the P&L directly. There we make the adjustments for allowances and disallowances. So there is a particular information which is captured in the ITR. If you track the history of the ITR from 6.7 or 5.6 onwards, when the electronic mode of filing came in, that time they had something called as a fringe benefit tax. I'm sure all of us would be aware of the concept called as a fringe benefit tax, which was applicable. So many information was captured for the purpose of fringe benefit tax and its requirements thereon. Okay. Schedule 3 went one step higher to Schedule 6 and made a lot of disclosures as a mandatory disclosure. Nothing say for example, rent. Rent is to be disclosed as a separate line item, even though it may be a very small component of your other expenditure. I may have taken on small space of rent. It may be only say 60,000 or less than 1,80,000. It may not be a number which is sizable enough, which mandates a separate disclosure. But since the Schedule 3 made it mandatory, we are presenting rent as a separate line item under other expenses. It cannot be grouped as miscellaneous expenses. Why was that brought in? Is because ITR had a separate line item called as rent. Advertisement charges, professional fees, legal fees. All these are items which captures as a separate line item. Traveling expenses, foreign travel expenses. All these are items which are captured separately in ITR. These are also forming part of separate disclosures as per Schedule 3. The same thing has been captured under this guidance note also. Since I said it's in line with Schedule 3, there is no change in P&L format. I can vouch for it. There's no change in P&L format. Every way the presentation of Schedule 3 happens for P&L, same way has been captured here also. There's no distinction there. So we start with the income, revenue from operations. We start with, then we go to other income. Then we find the total income. From that, we go to the changes in equity, changes in inventory, the purchases, consumption part. Then we go into the employee benefits, depreciation, amortization, other expenses, net profit. It even goes one step higher. As for exceptional, extraordinary items, if any, it goes furthermore to say if there is discontinuing operations, mention that, then give the net profit. This is how the P&L format which has been prescribed here. So why all this? Because it caters to various needs. Again, I was again thinking, why do you need a separate line item called as an discontinued operation? Or why do you need a separate line item called as an exceptional item on all those stuffs? Many a times a partnership firm may have some one-time income coming in. It may be captured as other income for us, but it is not actually an other income. It may be an exceptional nature, one-time activity which has come in, which may require a separate classification. It may not be even taxed under PGBP. It may go under capital gains or some other heads of sources. Okay, so we may have to look into the classification part, and that's where the requirement came in. And I also had an entity who had multiple businesses. He closed down one, started another. So when he closed down one, there was a significant loss in that particular business alone. But that loss is getting adjusted against the other business transactions. So to that extent, they have classified a discontinued operations here, capturing that particular information also. So it is very proactive way the institute has thought about in terms of the presentation format. So technically, your ITR 5 will be completely mapped with the presentation that we are giving under this particular format. So it's going to be easy to map the information into the ITR. If we were doing a bulk expenditure as other expenses without giving the breakup of it, now we will be forced to split that and give that data. Next, GSTR 9 and 9C complaint. Again, if when we are looking at the GSTR 9 requirements, it classifies the income into taxable under various rates and goes into say what is exempted, what is nil rated, what is non-taxable entities, then arrives at the total. From there on, how the ITC has been utilized, and then we have the reconciliation of the output tax and the input tax, and we arrive at what is payable. This is linked to the GSTR 3B data of how the taxability is paid by the entity. This again comes into picture because of the requirement of an entity may have multiple sources of income, and that needs to be disclosed in the financial statements. If we give one single line as a total income of the entity, which has taxable and non-taxable components fixed into it, then it becomes difficult for us to explain before the assessing officer when the assessment happens. Here, the standard, here the guidance note has split the income into so many parts by which it makes it mandatory to say that these are the taxable and non-taxable entities. I have my branch in Trivandrum has many small time or medium sized firms who are into petrol pumps. They have the firms are running the petrol pumps. They have, so technically petrol pump means it is not covered under GST. So the guidance note is far-fetched to think to say it also adds a line item called as excise duty component, if any. So it's not just restricted itself to GST compliance. It's also gone one step further and said, if it is an entity which is not covered by GST, then also there is an additional disclosure which can be looked into. So that's how they have framed the whole process. It insists that we have a cross reference. I've told this before. Then the item that we have to look into is the classification of current and non-current assets and liabilities. Again, very similar to what we do for corporates, we look into the operational cycle. Once the operational cycle is significant, then based on the operating cycle, we start classifying the assets and liabilities as current and non-current. So what's an operational cycle? From cash to coming back to cash, cash to inventory, inventory to debtors, debtors to cash again. This cycle is called as an operating cycle. And to that extent, if it is if it happens in a very small, quick time, then that becomes the operating cycle. But for many entities, we assume that 12 months is the comfortable operating cycle. So we go with the policy of 12 months being the operating cycle. Here also, they have given the same definition as per Schedule 3. If there is a particular cycle by which you can frame the entity to follow compliance part, we go with it. Otherwise, we look into only the 12-month cycle as the compliance part, and that will be the basis for identification of current and non-current. So the balance sheet is starting with equity and liability. Under that, after the owner's funds, we go into the non-current liabilities, then the current liabilities and the total. That's how it has been split. So we will look into each item in detail now. The financial statements has the word called as equity and liability, and in that it says the owner's funds. So every entity will have the owner's fund, which is sole proprietorship. It obviously will have the owners as his funds contributed for running the business. If it's the partners, then they have the partners capital account having that particular format. And so here it says that we have a disclosure in a particular format. What is the format they have given? It is an Ind AS format. They've gone one step higher and they have given like an Ind AS format. They have given the partners' names and other things. Then they start with opening. It's a tabular column they have given in a in a horizontal format. It starts with owner's capital, opening balance, current year additions, contributions brought into the year, whatever is the drawings taken during the year, what is the remuneration which he has drawn, what is the interest which has been added to the capital, and then the closing balance, share of profit and the closing balance. This format has been mentioned here. Again, why is this needed in the financial statement? If you recollect, ITR captures in this format. ITR captures the data of each partner, share of profit. It captures the remuneration paid to that partner. It captures the interest paid to that partner. In ITR 5, all these are captured. And for the individual, in ITR 3 or 4 or ITR 3 or 2, whatever is applicable to that entity, in that also we are supposed to give the share of profit, the remuneration part, the firm's name, the firm's span, which will be cross-referenced and cross-linked. Okay, there are instances wherein I have got information from various chartered accountants that they have received notices saying that the firm has disclosed a remuneration of so and so, whereas you have offered a lesser remuneration in your ITR, so the ITR is considered as defective under 139(9). The information is not true and fair. There have been notices that way. So they are looking to cross-reference the data. Since these are already happening at the ITR level, it's about time for us to bring it into the financial statements also. So financial statements, if it captures these items individually, then mapping to ITR will be much more simpler. Either the individual's ITR or the ITR of the firm, it becomes literally an easy value to capture. So these are the data. If there's any queries, I think I'll be open to take it during my session, either through the Zoom or from here. So please feel free to discuss any queries at any point of time. Now, going into borrowings, they have split the borrowings into current and non-current. What do we mean by current borrowings and non-current borrowings? Anything which is a working capital loan, demand loan, takes the shield of a short-term borrowing, which becomes a current borrowing. Anything which is a term loan, which is on long-term basis, takes the shield of a long-term borrowing. So the disclosure varies from there on. So what they insist for us to do is to split this borrowings into secured and unsecured. That is the first level of classification. I think it's coming in the next slide. So they want us to split whether the loan has been taken from banks or from third party. If it's from others, who are them? And I've just mentioned as from other parties here. In fact, the standards, the guidance note wants us to say if it's from related party or if it's from anyone else. So that also is to be captured separately. If there are any deferred liability payments, as to while we had that VAT related settlement loans, the overall VAT can be deferred as payment, and it was like a borrowings on a long-term basis. If you are an entity who is starting a manufacturing process in a specified area, the sales tax need not be paid on the every month. It will be accumulated and it can be paid over a period. That's how it was framed as schemes. If such schemes are available, that is also captured separately as deferred payment liabilities. Loans and liabilities from related parties to be captured separately. Long-term maturities of finance lease obligation, your AS 19 requirements, some come into picture, and any other loans and advances, we have to mention the nature. Further, we have to classify borrowings as secured and unsecured. How much of the borrowings is secured, how much is unsecured has to be looked into. So obviously all bank borrowings will be secured, either secured by the firms or the non-corporate entities' own assets, or it may be out of the partners guarantee or partners collateral being given. Those things have to be mentioned. Those things are separately captured here. Then we also talk about the terms of repayment. So again, for schedule 3, we have the terms of repayment for all the loans. We mention about the rate of interest, what is the starting period, what is the ending period. All those are captured as additional disclosure for schedule 3. Same way it has been captured here also. Current maturities of long-term debts is to be shown separately as short-term borrowings, very similar to what we do for the current year schedule 3 format disclosure. These are the classifications which is needed for borrowings alone. So the question that I faced when this is the third or fourth session on this, and whenever I took this session, the first question that comes up from the members is, isn't this additional work? Isn't this, is it going to be that remunerative for us to do this activity? What is the benefit that we are going to get out of this transaction? So the answer to this is very simple. Okay, the institute wants us to do it. I think if we don't do it, no one else will. So that's where the starting point. Whether we will be able to bill extra or not, I don't know. That's up to the individual chartered accountant and the auditee to handle it out. But all said and done, once these are being consistently followed, at least if we have a roadmap, say 3 years down the line, everyone will fall into this category. Then at end of 3 years, every financial statement which goes to the bank for borrowings will be comparable. And at that point of time, the thrust on an auditor's signature for a loan taken by non-corporate entity will come down. Now, any non-corporate entity going to the bank for loan, there are n number of certifications which they want a chartered accountant to do, which is actually available on the financial statements itself. But the banks don't want to take that as a responsibility. They want it to be given only as a chartered accountant signature with a UDIN attached to it. Then only it is being taken for acceptance. So once these financial statements become acceptable, presentable, and comparable across, these things will slowly start coming down. So that's what we have to look into. Yeah. The next thing that we may find it extremely difficult is classification of trade payables. What we are giving in schedule 3 is what has been adopted in this particular financial statements also. They want the trade payables to be split into amount due to micro, small, medium enterprises separately, amount due to other creditors separately. Please remember that schedule 3 to what is given in the guidance note, there is one small change. Schedule 3 wants us to disclose only the micro and small enterprises creditors in the face of the balance sheet. It is not MSME there. It is only the small and micro enterprises which is disclosed as a separate value in the face of the balance sheet for corporate entities. Whereas for non-corporate entities, it is micro, small, and medium enterprises which is captured on the face of the balance sheet. So that is a small subtle change between the corporate financial statements to a non-corporate financial statements. Again, why this has come in is because corporate entities are supposed to file a separate form called as MSME Form 1 every half year. If there is any default in payment to these MSME vendors, they are supposed to file a separate form in Form MSME 1, but there is no such compliance for a non-corporate entity. This is the starting point for it. We will be capturing the information of amount due to MSME, and we will be identifying it separately in the face of the balance sheet, and also giving a detailed disclosure of these dues in the notes to accounts. as to how much is the principal amount outstanding, how much is interest calculated thereon, what is the rate of interest, whether the principal due is still pending as on the date of signing the financial statements, is the interest still pending as on the date of signing the financial statements. Like that, a detailed presentation is mandated as per this particular requirement. So again, additional work. So if you go to your auditee and say, please get a confirmation from your vendor that he is registered for MSME or not, it is going to be a tough ask for us. So nowadays, what happens is many service providers make it as a part of their invoice itself. In the invoice itself, they mention that they are registered under MSME and their number is so and so. If such information is available, straight away we can take it as MSME registered people. Otherwise, as on 31st of March, at least the major parties, let's insist the auditee to obtain a mail confirmation that they are registered as MSME. If they were traders, if your auditee is traders, then to that extent, if they are directly buying from manufacturers, majority of the vendors may not be MSME. They may be only a small, they may be a big time manufacturer, they may not be registered under MSME. Otherwise, you may have a difficulty in obtaining this information, but it is mandated or it is suggested that we go ahead and obtain this disclosure for the purpose of financial statements. This becomes a presentation on the face of the balance sheet. I repeat, it becomes a presentation on the face of the balance sheet. It is not the notes which captures the information. On the face of the balance sheet, we split the total trade payables into amount due to micro, small and medium and others. That's how we split it out. Then they have introduced a new terminology which we may not have been using so far, called as provisions. For a non-corporate entity, provisions many a times may be only the provisions for expenses created at the end of the year. If they follow the accrual methodology, they may create a provision for say salary payable or provision for electricity charges. These kind of provisions alone we may have thought about, but they want us to think beyond that. They want us to say that if AS 15 is applicable to them, are they getting in complied with this AS 15? Now the question is, why will a small time entity start looking at actuarial valuation and compliance of gratuity provisions and all those stuff? Again, it becomes very, very logical for us to make a disclosure saying that an entity does not have a person who is getting covered under Gratuity Act. Hence, AS 15 is not applicable. It's just the disclosure which matters. It is not that they insist that you must get an actuarial valuation. They want us to check whether all possible provisions have been complied with. If so, how we have addressed it. Again, these are captured as separate line items in your ITR, and these get automatically disallowed. These get automatically disallowed in the 143(1) if you fail to disallow it in schedule BP computation as of the ITR. It's auto-populated these days. So if there are any provisions created, it captures separately, and the computation is also system-driven these days. It also talks about any other provision and wants us to follow the AS 29 for disclosure methodologies. What is AS 29 disclosure? It starts with opening. What are the provisions created during the year? Additional provisions. What are the provisions withdrawn during the year? Reasons for withdrawal, and the closing balance. This movement schedule is being recommended as a method for presentation here under this particular guidance note. The next point they have insisted is on deferred tax. How many of us think about deferred tax for a non-corporate entity? Again, many a times it may not be warranted at all, because for a the main reason for deferred tax for a corporate entity is the timing difference between depreciation. What the depreciation we follow as per the Companies Act to the depreciation followed as per the Income Tax Act. The difference is what is causing the deferred tax liability or the asset. For a non-corporate entity, we may be following the rates as prescribed by Income Tax Act itself. But we may not be mentioning that anywhere in our accounting policy, nor we may be mentioning that there is no timing difference. So that is where the standards come in. That is where this guidance note insists that look at timing differences. If it is logical for you to create a deferred tax asset or a liability, please do create, because we may have an entity who is loss making. They may be 2 years of profit, 1 or 2 years of loss. They may be reviving back after the COVID. So it may come back to a position where this year in March 22, you may be showing a profit number, whereas there have made a loss number in the last 2 years because of COVID. Once there is a turnaround, there is a carry forward loss which is available in the financial, in the ITR, which may require you to create a deferred tax asset provisioning coming into the picture. It is logical for you to recognize a deferred tax asset at that point of time. And that's what the institute wants us to do. It wants us to revisit every possible timing difference, every disallowances made, whether it will turn around at some point of time. If it's a permanent difference, obviously we're not going to create a deferred tax to it. If it is going to turn around at some point of time, then to that extent, a logical creation of deferred tax asset or liability is warranted. And that disclosure is mandated here. Okay. Then it goes into these were the liabilities part. Going into the assets part, they have introduced the terminology property, plant and equipment here also. We were using the terminology fixed assets so far. Under fixed assets, tangible, intangible were the words we were using so far for non-corporate. Now they have introduced the word called as property, plant and equipment. Why this has been introduced? Because your accounting standard 10 changed to state that there is a requirement to show it as property, plant and equipment. Here also they have taken the clue from there. They have made the fixed assets into property, plant and equipment, and have disclosed a split into tangible and intangible. Then CWIP for property, plant and equipment, asset under development for intangible assets. All this classification has been given, and they have recommended a reconciliation format. What do we mean by a reconciliation format? Opening block, additions, deletions, closing block. If you want to follow accumulated depreciation methodology, opening block of accumulated depreciation, additions during the year, withdrawal of depreciation, closing block, net block. The net block is what is getting reflected in the face of the balance sheet. The net block is what getting reflected in the face of the balance sheet. But a reconciliation, a detailed reconciliation is mandated here. Again, why do we have to do it? Is it warranted here? ITR already captures this. There's nothing new. ITR captures the various blocks which are available as per the IT rules, and it captures depreciation as per the block. If plant and machinery, they have 5 blocks for plant and machinery, starting from 5%, 15%. There are various blocks, 40%, 60%. Each block is different. So to that extent, there is already a format which is available in ITR. It is only the notes which were not mapping to these financial statements or to these ITRs. Now it will start mapping. Okay. So again, if you strictly go with the provisions of this guidance note, it goes with the gross block concept, accumulated depreciation concept, and the net block concept. Whereas we may be following only a block concept for income tax purposes. Nothing wrong with it. Opening block, additions made during the year, deletions made during the year, depreciation for the year, closing block is equally a proper disclosure as per this guidance note. They're not saying that you must go back and start recognizing the gross block, accumulated block concept. They're saying a presentation to show what was the opening, what is the additions during the year, what are the deletions during the year, and the net block value must be captured as a separate item is what they are insisting. So that's where they are looking at it. Then investments part. I don't think small micro enterprises have something called as an investment, but a medium sized or a large sized entity may have some investments. It may be fixed deposits, it may be in mutual funds for short-term purposes, they may be trading in shares or mutual funds. It may be there, we don't know. So if they have gone ahead and said, if such items are there, split it into current and non-current. If an investment is created for long-term purposes, treat it as a long-term investment, show the classification, show the valuation methodology, and they also go up to say, if it is a current investment, you must insist on following AS 13, which says for current investments, it should be valued at lower of cost or NAV, net asset value. If it is that way, you must recognize the difference as provision for short-term investments, and that has to be disallowed. All these are mentioned as separate line items in this particular guidance note. So they are very clear that we must make it as much comparable as a corporate entity for the presentation. That's what they are very clearly insisting here. Investments split to be shown, detail has to be classified, and we must state whether it's at cost or at NAV, what is the valuation methodology, and how the presentation movement happens. That's what they are looking at. They classify the non-corporate assets as security deposits, bank deposits for more than 12 months, and others. So if the entity is holding a fixed deposit, which is a long-term basis for a particular purpose, they want you to classify that fixed deposit as non-current in nature. That means to say they are not going to use these funds for short-term basis. That is the idea that has to be shown. Why is this needed? Because banks want to know how much backing an entity have in terms of funding. Whether they have fixed deposits, can they take a lien on those fixed deposits? All these are debated by the banks as stakeholders. To that extent, the disclosure comes in handy to support these kind of claims made by various stakeholders. Inventory, again, they want us to classify it like Schedule 3, showing what is raw material, what is work in progress, what is finished goods. If you are in trading, if the auditee is into trading of goods, separate line item for stock in trades. If they have stores and spares, loose tools, we have to classify each and everything as a separate line item. Again, this becomes a very important information for stakeholders for funding. Okay, they will fund only the raw material, work in progress, finished goods. They will not be funding something like a loose tool or a stores and spares. Now, if you give a single line item called as an inventory and it includes all this, we are actually misguiding the stakeholders in funding these activity, which is not correct as on date. So to that extent, the disclosure is made with the intent to ensure that there's a proper methodology of valuation of inventory and funding of that particular inventory. Goods in transit has to be shown separately, and they've also said the mode of valuation has to be stated separately, whether it's a FIFO or a weighted average method, and whether it's lower of cost or net realizable value. We must mention all this as separate disclosures is what is insisted. Again, to go back, we are doing this for Schedule 3, nothing new, same format adopted here. Going into trade receivables, again, trade receivables is classified into two parts: more than 6 months, less than 6 months, and then whether it's secured, unsecured, good or doubtful. All these are automatically the same idea which has been used in Schedule 3 has been incorporated here. If it is doubtful whether provision has been created, what is the strategy used by the management? And they also mention about the allowances of bad and doubtful debts, which is provision created for bad and doubtful debts to be mentioned. This particular bad and doubtful debts provision also has an aging schedule. Aging schedule meaning to say the movement schedule. What was the opening provision created? If anything was withdrawn out of the provision because the debtor paid back, I have withdrawn the provision, that also is mapped. Any additional provision created, that also has to be added, and then we arrive at the closing balance of this provision for bad and doubtful debts. Again, this will be a challenge for us once we start disclosing as more than 6 months, less than 6 months, it becomes an important requirement for us. We as an auditor will be documenting saying that these are more than 2 years, but the auditee fees these are recoverable and hence no provision created. We are creating a documentation to that extent, but it's not presented anywhere. Now the presentation comes into picture. That's where it comes in. If you look at ITR presentation, bad and doubtful debts, pan wise we have to give. We have to give pan wise. If the provision, if the bad debts written off is more than 1 lakh, we have to give pan wise information. If it's less than 1 lakh, we can give it as a single line item. Provisions created are captured separately in the ITR P&L schedule. Here that disclosure comes into picture. So that's why I said this is ITR compliant by major way. It just ensures that there's a seamless flow of information from the financial statements to the ITR and other areas. Bank balances are classified into these. Other than the bank balance with current accounts, they also want us to mention bank deposits on which earmark is happened. That's lien mark deposits, if any, that has to be captured separately. Margin money deposits given. We may have given a fixed deposit as a margin money deposit for say a sales tax case or say a GST being held back for some purposes. We may give a fixed deposit as margin money deposit that gets captured separately, and we must show deposits less than 3 months as cash equivalent, more than 3 months, less than 12 months as bank balance. That's how they want us to do. Again, that's what we are doing for Schedule 3 also. Any fixed deposits less than 3 months is considered as cash equivalent. 3 to 12 months is considered as bank balance. More than 12 months is considered as non-current asset. It's not considered as current asset. It is considered as non-current assets. These disclosures come into the picture for schedule for the compliance part. So quickly moving on to the loans and advances under asset side, they want us to be classified as advances from related party and others. That's the primary classification. And then secured or unsecured. And then what is the, whether it's good or doubtful. And if it is doubtful, whether provision created. This is the classification. So the challenge for us would be the details that are required here and how much we can capture it in 1 year. So one of the questions which was thrown open to me was, what if I'm not able to make all the presentation in 1 year? Answer is okay. As much as you are in line to ensure that you have a target date, say 3 years, and by the 3 years, all the disclosures will come in. It is very much appreciated that you give. For example, you may give it as loans and advances. You may not be able to split as current and non-current. So you're showing everything as current. Perfectly fine for the beginning to start with. Going forward, after 2 years, revisit, and then you will find something is non-current in nature. At that point of time, you can reclassify the balance sheet. There's nothing wrong in reclassifying the balance sheet to kind of make it more presentable. So that's what is the intent of this particular presentation. So any doubts in balance sheet so far? This is about the balance sheet part. There's one question online. I just try to take it. Someone is saying it's not available. It was sorry, way back at 5:15. Not something that we can. Okay. Any other doubts in Schedule 3? I mean, sorry, in balance sheet format. Shall we proceed? Yeah. Okay. So going into the income and expenditure part. So going into revenue, you can see the classification given. They have said revenue from sale of products. That is further bifurcated. If you want to give further bifurcation as traded, manufactured, you can go ahead and do it. If it attracts a special characteristics, you can even do that kind of a activity. For example, you may be dealing with items which are nil rated for GST purposes. You can capture that separately. It may be at different rates of GST. You can even show it at different rates to ensure that it is mapping with your GSTR 9 and 9C. So sale of products can be further bifurcated to suit the need of requirement. Then it talks about sale of services. If there are any service provided, that also is captured separately. Why this is significant? I'm sorry, why the next point is significant is because it also does not only think about sole proprietorships and firms, it also thinks about non-corporate entities. It also says any grants and donations received. If a particular cooperative society does not have a format of balance sheet P&L, you can still comply with that, is what the guidance note says. There's no hard and fast rule that you cannot comply with or you cannot follow, you need not follow this standard or this guidance note. Anyone other than a corporate entity can follow this particular guidance note, is the idea given. That's why they have given something called as a grant or a donation received as a separate line item for a non-profit organization or an entity which is collecting donations. That also can be captured. After this, they are saying any other operating revenue, anything relating to revenue, not directly related, but an incident out of the whole operations, is captured as an other operating revenue. For example, you may have an exporter. Earlier, there was something like the VKY schemes or the scripts which were traded. You will get an export import related script which could be traded in the open market. Those things have come only because of the export which has happened by that made by that entity. So it is an operational factor which is captured, considering that they have mentioned that as a other operating entity. One more question. One question which has come online: do we need to show all the provisions with movement like opening, current year changes, write-off and closing? Answer is yes. Answer is yes. Wherever there is a provision created, you have to show the movement. AS 29 insists on that. Not only AS 29, ICDS on provisions also mandate that we make a disclosure. So what are these provisions which needs to be looked into? When you're looking at the format of the balance sheet P&L, there are certain provisions created for debtors. There are some provisions which are created for loans and advances. These are the ones which are to be looked into. Whether a provision created for obsolescence of inventory, whether that has to be shown as a movement. If it is captured as a separate line item in the financial statements, it can be shown as a movement item. For India's balance sheets, for that also we do it, but not mandated for this particular financial statements. Say, for example, trade receivables or loans and advances assets for which you have created a provision, those items movement is mandatory. If you come into AS 15 requirements, if you are creating a provision, additional provision during the current year, then the movement comes into picture. That time you will be following the procedure of making the disclosure. Otherwise, it is not a thing which will come into picture. Hope I have addressed the question which has been raised by Mr. Zakir Hussain. So yeah, if you look at the balance sheet, P&L, they've also said less excise duty. See, they have gone one step higher to think to say that there may be non-corporate entities who are liable to excise duty still or VAT still. So those kind of disclosures also is coming into the picture, and they're making a separate disclosure wherever needed. Yeah. Then other income, I have not spent much. I have not prepared a slide on it. What they insist on another income is if you have any other income like a rental income or a dividend income or a interest income, it is captured separately is what they are telling, and that has to be mapped separately. Why this is mapped separately? Because these are not taxed as income from PGBP. These are mapped under income from other sources or capital gains or house property income. Once it is captured as other income here, you show it as other income. If you find the present ITR, if you are eliminating an item from PGBP as to be taxed under the other sources, other heads of income, it gives you a pop-up saying that which source of income. So it is asking you to ensure that you show this, you eliminate from one area, add it to other area. That is the reason why we also have an other income classification given under this particular guidance note. Then going into cost of goods sold. cost of goods sold is classified into cost of material consumed, purchase of stock in trade, changes in inventory in finished goods, work in progress, and stock in trade. I mean, the column D is wrong. It is changes in inventory of finished goods, comma, work in progress, and stock in trade. That's how it should have worded. I'm sorry, there's a small change in the presentation. So that's the way they want it. So what is this purchase of traded goods? If you are a trader, if your auditee is a trader, then he will have only purchase, opening stock, closing stock. So that's how the changes will come in. If they are into manufacturing, some small manufacturing activities happening, then you will have consumption of materials coming into picture and a work in progress coming into picture. These details are automatically captured here. Not only here, please remember, ITR also captures these information separately. For manufacturers, there's a separate column in P&L. For traders, there's a separate column. And then only it starts with the revenue part and the other expenditure part. So information is captured in ITR, and that information is split for better disclosure in the financial statements now. Then it also talks about the concept called as, if your expenditure, any expenditure exceeds 1% of your total revenue or 1 lakh, whichever is higher, please make a separate disclosure. Okay. It obviously mentions something like have a separate disclosure for rent, have a separate disclosures for advertisement charges, professional fees, legal fees, rates and taxes, donations paid, what else? CSR, if any. I mean, that's for corporates. Again, they have mentioned something like contributions towards these organizations, like donations and other things, to be captured separately. And then they have said that anything more than 1% of your turnover or 1 lakh, whichever is higher, please capture it separately. This is very, very crucial, because I may have an entity who is spending a lot of money on traveling because the business requires a lot of travel. Okay, there may be a significant travel cost involved, or a significant disclosure display cost involved in the particular transaction. If it is significant enough, that has to be captured separately. And why is this capture coming in? 2 points. One, if there is any TDS requirement, whether that gets attracted. Okay, 1 lakh is the limits for TDS, 194C. 1 lakh is the TDS requirement. That's the basic of all the contracts. Next is the disclosure requirements under the ITR itself. Every single line item, there are so many line items which are available, and that will come into light when you start making such disclosures. So that is what is the significance that they have thrown open. They have only given the minimum line items which has to be disclosed in P&L, very similar to what the Schedule 3 wants us to do. We have to give the minimum line items. They're given minimum line items to be disclosed. Other than this, anything which is significant as an expenditure incurred by the entity has to be disclosed separately. Okay. Then it also talks about a detailed disclosure about the employee benefits, salaries, wages, bonus. If we are following actuarial valuation, any relating to actuarial valuation has to be captured. If the auditee is complying with PF ESI regulations, that also is captured as any contributions paid to defined benefit plans and other plans. So it is giving a separate disclosure for employee benefits. Again, not new at all, because ITR, your employee benefits or the salary payments is split into various categories. It's split into various categories as salaries, how much, wages, how much, bonus, how much, gratuity, how much, contribution to provident fund and others, how much. Everything is captured in your ITR as a separate line item. As a separate line item, same thing is captured in this particular format mentioned by ICAI also. So we must ensure that all these informations are captured, since it is more and more transparent in terms of making the disclosure. So that is what has been insisted. Then it talks about exceptional extraordinary items. I've mentioned about that. Then net carrying amount of investments, it is throwing open a line item, or it wants you to make an additional disclosure in the P&L. If you are valuing your investments at lower value of NAV, creating a provision to reduce the cost to the NAV, that has to be captured as a separate line item, is what the schedule, the disclosure requirement which has come in. The net gains or losses on foreign exchange transaction, if any, has to be given. So this is about the P&L part. So any doubts on the P&L part? So it starts with revenue from operations, other income, total income, split of expenses as cost of material consumed, then employee benefits, depreciation, amortization, finance cost, other expenses, profit before tax. Then it splits. In fact, if you go through the financial statements, it splits the taxes into three parts: current tax, provisions created for earlier tax, if any, deferred tax. That's how they have worded the P&L here. And then it goes on to capture the exceptional, extraordinary items, discontinued operations, and ends up with the profit after tax, which is further appropriated to the partners or the sole proprietor. So any doubts? There's one question which has come online about B&D provisions. Okay, bad and doubtful debts provisions. We should take the stand of management despite aging report figures. Does auditor mention about our opinion if we have a difference with the management about providing for bad debts? If aging shows major figures as more than 365 days and the management is not willing to take a provision, what is your opinion? Okay. And sir, there are two ways of looking at it. One, if the business has slowed down because of COVID and there are confirmation of balances from the debtors that they are willing to pay back the dues, then provision need not be created even if it's more than 365 days. Again, I tell you, if there are confirmations available to satisfy our opinion that there is no requirement of a provision, we may not insist on creating a provision. But if you are confident that there is a provision to be created, but the management is not creating it, we always have the 3CB to opine on. We can make it as a point of observation in 3CB and we can give it. So it is always available, not only here, erstwhile also we used to do that. I have done it in a lot of 3CBs where there were amount dues for more than 2 years. In that scenario, I have mentioned it as it is the provision. I feel there's a provision required, but the management has not created provision. To that extent, I am not qualifying, but this is the disclosure needed, is what I have mentioned. So it's up to the auditor to take a call. If you have documentations to satisfy yourself, you need not create a provision. Otherwise, you can insist on putting it in your audit report. There is nothing wrong in that particular fashion. Hope I have addressed that. Any other questions on P&L? Shall we proceed? So going into this accounting standards, again, has split the accounting standards into 4 parts. First is applicable to large sized entities, more than 100 crores turnover and all those stuff. Obviously, turnover and the plant and machinery size is the structure for this classification. MSME ka same documentation. They have split into large size entities as level 1. All the standards are applicable in the fullest form for this level. So if your entity falls under level 1, cash flow will be applicable, AS 15 will be applicable, AS 29 will be applicable, AS 22 of deferred tax will be applicable. Everything will be applicable in full for level 1 entities. No compromises, no benefits given for lesser disclosure. Whereas if you fall under medium sized, out of the 29 1 to 29 standards that we have, 5-6 standards straight away is not applicable. And further, they have said certain disclosures are not mandated for these entities. If it falls under 3 or 4 category, then very comfortable. Most of the standards are not applicable or disclosures are waived off for these entities. But we must write that these entities, that their auditee is falling under category 3 or category 4 of the accounting standards, and hence disclosures made in the financial statements is restricted to those which are applicable to the entity. That word or that line is mandatory to be given in every financial statements which we are signing in this particular year from March 22 onwards. Please, I insist or I request, or through this guidance note, the ICAI themselves request that we make it clear that all the applicable standards are disclosed. If an exemption is available, please mention the exemption as and when possible. That's what they're trying to state. Yeah, that's what I've given here. So what we have to do, another question if I'm not wrong, yes, do we need to show details of one of the asset sale from a group assets other than fixed asset schedule? Got it from have also its GST impact. We have to show details of one asset sale from a group of assets other than fixed asset sale. If it's a part of fixed assets, you will be reducing from fixed assets. If it's not a part of fixed assets, if there's any other assets which are being sold, we have to show it separately only. If it is forming part of your other income, then to that extent it is getting classified as other income. GST impact, if it is liable for GST, we will show it. Otherwise, we'll have to show it as exempted category in the GST return. I hope I have answered it. If I'm not, if you can put down the question in detail, I'll be able to address it. So coming into this, how we can look at this year's audit, what are the things that we need to do, do's and don'ts for the current year audit. First thing is about the, obviously every time, if it's a new entity, please take an appointment letter. Otherwise also take an appointment letter to be on a safer side, because that is the primary document which gives us the permission to look into the books of accounts of an auditee. So an appointment letter is something which is mandatory in nature. If it's a first time audit and it was already audited by some other chartered accountant, obviously as an business ethics or of the professional ethics, please take a no objection from the erstwhile auditor. I feel bad many a times when I have to let go some audits. I find many chartered accountants don't even ask whether I have an objection in them taking over the audit. I know who has taken over. I know personally them, but it becomes a very tricky situation whether they have, they are not asking a no objection to me. I may have an objection. How do they know? It's better that they ask, because the client might not have paid my fees. I have to tell them that my fees are due. It will still be reflected as provisions in their books, but it's still due to me. Unless the dues is cleared, I still will not be satisfied in giving that client to anyone else, you know. So a no objection is something which is mandatory. Please do take a no objection letter. Mandatory requirement is to take an engagement letter. There is an engagement letter format for all this. Please take it. My personal experience with peer review, I was thinking that peer review will pick up only bigger files and they will ask questions only on the bigger files. To my surprise, out of the sample selected by them, almost 40 files were small time or firms or non-corporate entities. And the questions they threw open was all this. Do you have an engagement letter for this transaction? You have given a certificate for this entity to the bank and you have certified and given a UDIN for this particular thing. Do you have an engagement letter for that certification? That was the question which was asked by the peer reviewer. A lot of eye openers in the peer review, which happened a year and a half or 2 years back for me. From that, I mean, before that, we had it for the bigger assignments, not for certifications for small time non-corporates. for bigger corporate entities, along with the engagement letter, we take a general engagement letter for all certifications. It was already a part of our documentation. I think he picked up the clue from that, saying that you already have it for a corporate entity. Why not for a non-corporate entity? May have been his question. But again, it is an eye opener for us. We found that, yes, the standards require us to get an engagement letter for every activity that we do. So considering that, if you are doing a we were doing GST audit and tax audits, we were supposed to take 2 engagement letters. So that's how the documentation formats are looked into. So please look into engagement letters, mandatory requirement. Be very specific on what your terms of engagements are and how you will be making the disclosure. If it's tax audit requirement, then you specifically say only for the purpose of 44AB and its disclosure thereon. Don't take any additional responsibility to that extent. That's about engagement letters. Points to be followed up from previous year, like what I mentioned. If you wanted to create a provision, but the client was not accepting it, you can mention it in Form 3CB, and how that has been addressed in the current year. All that documentation is something that you might have to look into. Last point is IFC and RCM, internal financial controls and risk control matrix. I don't think I have been successful in implementing it for all non-corporate entities. If it is possible, please do take it. That is something which will help you in your audit documentation. One more question. Whether SA is applicable for audit reports apart from 3CB? Yes, 100% applicable. Any audit done under by a chartered accountant under any law, we have to follow the standards on auditing. No doubts about it. In fact, in your 3CD report, you have to mention that you have complied with it. It is much safer. You can say that I have relied on the standards of auditing for my auditing standards or for my auditing purposes, and that's how I have made my process of auditing. It is actually a mandatory requirement. There's no doubts about that. Then next thing, something which I when an entity comes to me for audit, these are some documents which I definitely ask them to give. It is better that you also do it. It's safer for us when we certify. Physical verification of assets along with the reports, if any, physical verification of inventory. I was surprised to when I went for the bank audits for this year to Bombay for a couple of branches, where we are central statutory auditors. The way the chartered accountants draft their 3CB report, it's an art that we need to know. I have not drafted it so far. Out of my 15 years of my certification of 3CB, I have not drafted it. I've seen Bombay chartered accountants certifying earlier, but this large branch that we looked into and the non-corporate entities of these large branches, the chartered accountants are very, very clear. They don't want to take some responsibility. For example, one of the points in 3CB is the partnership firm has purchased assets worth so and so. I have not verified these bills, but the depreciation calculated is in line with depreciation rules. That's how they have written. So it's an eye opener. Why? Because that person would have come towards the last. It happens to us also. They come on 30th of September expecting us to file the 3CB report on 30th of September. At that point of time, how much can you verify? So these lines, are these comments which I saw in the 3CB reports were actually an eye opener. And they did mention that the engagement in the 3CB, they have mentioned that the engagement letter signed by the auditee was only for the purpose of this certification. However, any other stakeholders relying on this particular financial statements, I am not held responsible. They have written that in 3CB. That means to say I'm only looking at the PGBP calculation. I am not, if you are looking at this for loan purposes, don't take it. I am not held responsible. I cannot take the responsibility of whether the current and non-current is right or whether the turnover is mapped to the GST. I cannot take all the responsibility. The profit is there. The allowances and disallowances are there. The ICDS requirement is there. I have ensured only that compliance. That's what they mean. So very, very clear wordings they used. And it was really an eye-opener for me to see such wordings. And obviously, I have not seen it in the past. or it is an off late trend in Bombay. I don't know whether that's happened, but these were certain things which were really a good eye opener. Why all this is because of these documentations which are missing. If we must insist that we take all this, if it is not there, we may have to put it in the 3C reports, word our 3CB suitably. I think Zakir sir asked about the provisions for bad and doubtful debts. I have also made that as a point here. Confirmation of debtors and reconciliations, if any, it may be if needed. Please do it. If you feel that it is more than 3 years, I mean more than 365 days, but you want to create a provision, the auditee is not allowing it, ask them to give a confirmation of balance. That is the easiest way of documentation which we can rely on. Creditors confirmation, creditors MSME confirmation, something that is mandated for the current year. List of related parties, very, very crucial for non-corporate entity, because we are certifying something called as 48(2)B transactions. All the related party expenditure we are certifying. We may not know someone is the brother-in-law doing the same business, and this is a transaction between these two firms. There may be two firms, one firm may have purchased from other. So to that extent, my purchase may be from a related party. I may not know unless and otherwise it is disclosed to me. So list of related parties, mandatory that we take it for any non-corporate entity audits. Unless and otherwise you're 100% sure, you know every transaction, don't take any chance. Please take the list of non-corporate risk of related party transactions they have entered into. Obviously, bank balances confirmation, some routine transactions, cash balance confirmation, especially for traders who give year-end sale. The year-end mega sale which happens towards the end of 31st of March. There's a huge cash accumulation which comes in towards the last 15-20 days. Very, very important that we take the confirmation of balances and ensure we have some methodology to check it. Very, very important documentation. Confirmation of bank deposits and interest accrued thereon. Confirmation of electricity deposit. This is something which always gives the twist. These days, fortunately, all electricity departments have been fortunate enough to file the TDS returns on time, and it is getting reflected. The interest is getting reflected in 26 AS. Otherwise, it was a challenge 2.5 years back, 2 years to 3 years back. Last 2 years, somehow it is mapping in 26 AS. Therein, we are able to identify this income and show it separately and claim the TDS. Otherwise, it was going a waste. Contingent liability list, we may know only the list if you are having the user ID password of the auditee for income tax. We can at least know what is the outstanding dues or cases pending for income tax. Other than that, all other contingent liabilities, we will not know unless you are doing the GST assignment also and you have the GST logins also. Please take the confirmation of confirmation that there's no contingent liability. Something which in our office we make it as a mandatory requirement is reconciliation of inward and outward supply of GST. If they have multiple state presence, state-wise also we insist them to give. If it is not possible for ITC, at least the turnover reconciliation, please map it, because in not under GST era, under the service tax era, I had a notice from income tax department saying that you have filed a service tax return of so and so, whereas your income in your income tax return is only so and so, and they had asked for a reconciliation. So they are already under the service tax era itself. They were cross-referencing the data. So under GST era, it's much more seamless and easy. So they will be able to do it. Copies of all the orders received during the year, income tax, VAT, central excise, sales tax, or VAT, GST, whatever it is. Why? Because in 3CD, you're giving in 41 clause, you're giving all the indirect taxes status in one particular format. Either it's a demand or refund. You're mentioning that in that clause, you're taking a certification, you are certifying that. So please do take that list. List of additions made during the year. If possible, take the copies of additions for records. I don't know how many of you face this. I have one assessment which is pending on large listed entity, made a capital addition of 19 crores during that year. The income tax department wants bill of 19 crores of assets. I have tried to upload the information. The size was so huge, it didn't get accepted. So I wrote to the income tax department. They split the notice into 3 and asked me to upload in 3 different notices. I still uploaded. After that, they sent a notice saying that please send all the 12 months bank statements. This entity had 32 bank accounts. So it's a challenge in faceless assessment. So it's no surprising that the department will ask such queries. If it's possible, upfront, please take the scanned copies if it's possible, so that if you're handling the tax assessment also for these entities, it will be easier to manage it out. Any other doubts? So that's the end of my presentation. I'm also I'm on time to close the presentation right on 7. So if there's any other doubts, I'll take it. I don't find any other queries online also. And all 4 seems to be answered. Thank you so much. Yes, sir. There's one which has come up here also. Thank you. Yes, sir. Tell me, sir. In terms of NGOs, okay. Again, sir, this is only recommendatory in nature. Not that this has to be followed. As much as possible, you can try to comply with it. If it's a non-profit organization, technically your accounting standards gives a leeway in many places. It does not insist on a lot of presentation or disclosure therein. This guidance note also gives you a very clear instruction. If it is a profit-oriented organization or a non-profit organization, you can follow this format of balance sheet P&L to the extent it is applicable to you. Yeah, definitely you can. No issues. They have given from note number 2 to note number 20 or something in balance sheet. If it is not applicable, you can very well eliminate. Not an issue at all. One online question has come, whether we need to show all notes in details, even if the data is nil. I think that's the question which was asked here. Not necessary. If there is no transaction the current year or the previous year, you need not give that information. For example, if you don't have a long-term borrowing, you need not show a long-term borrowing under non-current assets. If it's only like a working capital facility available, it can be shown only as short-term borrowings. Not needed to disclose as a long-term borrowing and show as nil. Hope I've answered it. Yes, sir. We don't have a gross value and accumulated depreciation block. Yes. No, we can still continue the same thing, sir. No problem with that. But like the ITR, please have the opening block, have the additions during the year, deletions during the year, have the depreciation for the year, and the closing block. That should do. That should do. They do give you a format of open gross block, accumulated depreciation, net block. As much as possible, if it's a new entity, start away. You can I insist on following this. If it's an entity in existence and you're finding it difficult, you can still say this, and you can mention this in the notes to accounts, that this is the way we are presenting. Any other questions? So thank you so much. Thank you for the opportunity.
Good evening once again, and now this the presentation was really an eye opener for us, and this financial reporting guidelines on this non-corporate entities, if it is implemented correctly, it will definitely serve as a tool to bring in more transparency for these entities, and this will also bring in more comparability of this information, as these entities has to report their financial transactions in standardized formats. And definitely adopting these guidelines is not an easy task for us, because presently we are right now reporting just the financials, just a simple balance sheets, P&L, and some notes. And to bring in these informations that these guidelines require, definitely we need to have a thorough sitting with the management. The auditor needs to discuss a lot with the management, and as chartered accountants, we all need to draw a clear roadmap in which we need to adopt these guidelines. And definitely, uh, I understand that the in Excel format is available right now in the internet, and it has to be adopted. And some of this information we can definitely move in the this year itself. And by the end of 2-3 years or something, we can have an financial statement which is more or less giving all the informations that the ICA guidelines do suggest. And it's a very eye-opening seminar. And on behalf of the branch, uh, I would like to thank CAG Rengarajan, and I would like to call upon Selim sir, past chairman, to present the memento to sir. Thank you, sir. So members, please do take time to support the Women's Initiative. It's the August 20th. You should specifically make time for the same. It's a full day seminar. And for a formal vote of thanks, I do invite Satish TG.
As our chairman rightly pointed, this seminar was really an eye-opener to us. Most of us will find that we are missing a lot of things in our presentation of our financial statement, mainly in tax audit. I thank on behalf of Thrissur branch, CA Rengarajan sir, for traveling to Thrissur and educating our members. Thank you, sir. I also thank CA Paulson sir for the warm introduction of the faculty. I also thank the members who physically present here, and the members who watched us online. And thank you.